Welcome back to the deep dive. Today we are strapping in for a really high velocity look at global monetary policy.
Right.
It's a subject that's often shrouded in this, complex jargon, but it has these profound immediate consequences for your savings and your financial stability.
It's essential material. We're diving into a listener's request to really decode these massive unconventional monetary policies that have been adopted globally since the 2008 crisis.
The code red policies.
Exactly what the source material calls code red. And we need to understand the mechanism here, this sort of steady erosion of savings, and the new layer of global financial risks they've introduced.
We're talking about the deep end of central banking, the alphabet soup of ZIRP, QE, LSAPs, all of it.
Yep.
Our mission today is pretty simple. Decode this complex system and, more importantly, pull out an actionable playbook for surviving and, maybe even thriving in this volatile new financial reality.
And our source for this is the really rigorous research in the book Code Red.
Okay, so let's unpack this.
We have to start with the sheer scale of the crisis that triggered these policies.
Yeah.
The source establishes that Code Red was necessary to prevent a literal global financial collapse.
It was that bad.
In late 2008, major banks in the US and UK were, and the source notes this, literally hours away from shutting down. Global trade had essentially frozen.
Frozen.
Yeah, because banks just stopped trusting each other enough to issue simple letters of credit. Everything was grinding to a halt.
A true systemic emergency.
Yeah.
But the critique isn't about the initial decision, is it? It's about the dosage and the duration.
Precisely. The source argues that the economic medicine administered zero interest rates, massive money printing, was dispensed in once unthinkable dosages, and while the patient survived, these treatments will almost certainly bring on long-term unwelcome side effects, specifically sustained inflation and market instability.
And this wasn't just the U.S.
No, not at all. The Federal Reserve, the Bank of England, the ECB, the Bank of Japan, they've all gone all in on this unprecedented monetary intervention.
Our goal today is to understand what all in means for you, the learner, who's just trying to save for retirement, and how you can build resilience against those side effects. Let's start with the basics of these code red policies. What exactly are zero interest rate policies, ZIRP, and quantitative easing, QE? And who is this whole game designed to help?
Well, ZIRP and QE are the primary tools left to central bankers when their preferred solutions, like achieving genuine organic economic growth, are elusive.
And the other option is what? Letting things collapse.
Right, and allowing painful, necessary debt defaults is just. It's politically unacceptable. So when they're faced with an overwhelming debt burden, they have only one reliable option left: to strategically erode the value of that debt through inflation or currency devaluations.
So if I understand correctly, the value of the debt goes down in real terms, but my dollar or my yen or my euro, it buys less at the grocery store.
That's the mechanism. And the winners are very clear. Governments who can finance their massive deficits at near zero costs, and large financial institutions who can borrow money for almost nothing and then lend it out at higher rates. Debtors, broadly, also benefit.
Because inflation is eating away at what they owe.
Exactly.
But who are the losers? It sounds like it's the people who are, doing the right thing.
It is. The clear losers are savers, pensioners, and the elderly. Because of ZIRP, they receive almost no income from their savings, from money market funds or traditional safe bonds.
Which forces them into riskier assets.
It forces them to either accept a zero return or venture into riskier investment just to try and maintain their purchasing power.
Now, here's where it gets really interesting, according to the source. The Fed has essentially adopted a third unofficial mandate.
Beyond its two traditional goals of stable prices and full employment.
Right. And this third mandate is basically to make stock prices go up through these large-scale asset purchase programs, or LSAPs. They're trying to generate what they call the wealth effect.
That's a huge claim, and the evidence for it is pretty compelling. The central banks buy bonds, which pushes down long-term interest rates. So investors...
They have to go somewhere else for a return.
They take that guaranteed low-yield bond money and move it into equities to chase higher returns. The stock market soars, and the Fed hopes the resulting sense of wealth encourages people to go out and spend.
But critics argue this wealth effect has massive social consequences.
It absolutely does, because, the wealthiest 10% of the population, they own the vast majority of investment-grade stocks and financial assets.
The rising tide only lifts the yachts.
Pretty much. Middle-income families often have very little exposure. So QE and higher stock markets did nothing to solve high unemployment or generate wealth for the poor. They primarily intensified the prosperity of those who are already rich.
Okay, so these policies helped the rich domestically. But these actions didn't happen in a vacuum, right? They provoked a dangerous international reaction.
Yes, and that draws these really interesting historical parallels to past currency wars.
Let's look at that context.
To understand today, we have to look at the differences between the two great currency wars of the 20th century. So the 1930s versus the 1970s.
Okay.
In the 1930s, countries like Britain abandoned the gold standard specifically to escape a crushing deflationary spiral. These were so-called beggar-thy-neighbor competitive devaluations.
And the goal there was literally to devalue their currency enough to just get their economies breathing again.
Exactly. And while that initially harmed global trade, some experts, like Barry Eichengreen, have cited the resulting monetary stimulus as critical for initiating recovery. The enemy then was deflation.
So what changed in the 70s?
The 1970s currency war started after President Nixon unilaterally ended the gold convertibility of the dollar in 1971.
The end of Bretton Woods.
The demise of the Bretton Woods system. In that era, competitive devaluations were driven by a desire to stimulate domestic demand when inflation was already moderate or rising. That's the key difference.
And that led to
a vicious cycle. Rising oil and food prices led to workers demanding higher wages, which led to cumulative inflation climbing over 50% in that decade alone.
So the 1930s was fighting deflation with devaluation. The 1970s was just pouring gasoline on an inflationary fire. What does this all mean for today?
Today's currency war is driven by developed central banks, led by the U.S., competing to see who can loosen monetary policy the most via QE, ZIRP, and weakened currencies. They're trying to export their domestic problems.
And the most aggressive player here has been Japan, with its massive experiment, Abenomics.
Absolutely. Japan, facing 2 decades of crippling deflation and a massive public debt, a staggering 240% of their GDP, committed to doubling its money supply.
Doubling it.
Their objective is to generate 2% inflation to make that colossal debt burden manageable. I mean, that debt number is just, it's breathtaking.
How does a developed country even begin to manage that without triggering mass panic? What are the specific risks the source points to?
The risk is the collateral damage. Japan is effectively trying to export its deflation by making its exports cheaper globally.
Which forces other countries to react.
It forces other nations, particularly their export competitors like Korea, Thailand, and China, to react. They are now compelled to intervene in their own currency markets or impose capital controls to stop their currencies from appreciating too much.
It's a global arms race then. If one nation fires a QE round, everyone else feels the impact.
Duvuri Subbarao, the governor of the Reserve Bank of India, he summarized this perfectly. He said, every time there is quantitative easing by the Fed, we all have to reckon with the spillover impact.
When the biggest players devalue, the entire global economy is destabilized.
That's the problem.
Okay, the central mechanism for all these policies, this invisible transfer of wealth from savers to governments, is financial repression. That term sounds like a conspiracy theory.
It does, but the source defines it clearly as a state-sponsored policy. It is an opaque term for a very subtle hidden tax.
A hidden tax.
Financial repression is when governments and central banks artificially reduce borrowing costs for government debt while, at the same time, generating inflation. It's a policy that basically says, if you saved responsibly, we are now taking a percentage of your purchasing power every year and giving it to the borrower.
And the biggest borrower is often the government itself.
Often the government itself.
So how is this actually executed in the real world?
The economist Carmen Reinhart laid out the key elements. Governments do this by capping interest rates on their debt and then forcing institutions like banks, pension funds, and insurance companies to buy large amounts of those government bonds.
And this leads directly to the ultimate mechanism of repression, negative real interest rates.
Correct. The real interest rate is just the nominal rate you earn minus the inflation rate. So let's say your bank pays you 2% interest.
Which would be generous today.
Very generous. But if the actual inflation rate is 4%, your real return is actually negative 2%. You are losing purchasing power over time.
And this hidden tax is brutal for those who are fiscally prudent, especially retirees.
Yes. The data in the source show that state and local pension plans in the U.S. are massively underfunded. Some estimates of the shortfall exceed $4 trillion.
Wow.
And negative real rates make it impossible for those plans to earn the returns they need to pay their future obligations.
And the Federal Reserve, as we discussed, isn't particularly worried about savers.
No. In a heavily indebted society, the politics and the economics all align toward helping debtors, not savers, and this forces many responsible retirees to work longer.
I think I saw a stat on that.
Yeah, the average retirement age in the U.S. hit a low of 62 in the mid-90s, but today it's 64 and climbing. It's a direct consequence of low returns on savings.
A crucial point here is how inflation itself is measured. The official statistics, like the core PCE.
The Core Personal Consumption Expenditures Price Index.
Right. They often yield lower inflation figures than the traditional CPI, the Consumer Price Index.
Wait, for the listener who doesn't track Fed metrics daily, why do we care about the difference between these two? What's the point of using the PCE?
Well, the PCE is the Fed's preferred metric. It tends to smooth out volatility by adjusting the basket of goods more frequently and excluding certain volatile components like food and energy.
But if you calculate today's inflation using the same methodology they used back in 1980, which was arguably more reflective of common household costs,
The number jumps.
the real number jumps from the official figure right up to about 9.6%.
And those small differences matter tremendously because the official CPI figures are used to calculate tax adjustments and, crucially, cost of living increases for Social Security. Undermeasuring inflation means retirees get smaller checks than they truly need.
That's right.
So this all raises a really important question. How confident should we be that central banks can actually manage the exit from these code red policies?
Historically, we should not be confident at all. The source points out that economists have a virtually unblemished record of failing to predict recessions.
An unblemished record of failure.
And they often fail to even recognize them in real time because they focus on lagging indicators.
Driving by looking in the rearview mirror, that's a fantastic, terrifying image.
It is. They're focused on unemployment and GDP numbers that tell them what was happening 3 months ago instead of forward indicators.
We saw this during the housing crash, didn't we?
Vividly. Alan Greenspan and Ben Bernanke insisted a housing bubble was a pretty unlikely possibility, or that spillovers from subprime wouldn't be significant, even after the bubble had definitively burst.
So if they misjudged the onset of the crisis, why haven't we seen hyperinflation yet, given the massive amounts of money printed through QE?
That's because of low money velocity.
The speed at which money turns over.
Right. The speed at which it turns over in the economy. Right now, we're in what's called a liquidity trap, where banks are just sitting on vast reserves rather than lending them out.
So the money isn't moving.
The money isn't moving. That stops the inflationary pressure from building.
Okay, but what's the trigger? Skeptics would say we've been sitting on this potential inflation since 2008 and nothing's happened.
The source material uses a great analogy. The massive increase in the monetary base is like gasoline on wet logs.
Okay.
As long as velocity stays low, the logs stay wet and everything is contained. But if velocity starts to rise, maybe as credit deleveraging finally gives way to credit expansion, that mountain of money could create a massive inflationary blaze very, very quickly.
Faster than central banks could react.
Far faster. And the core problem is that when the Fed does decide to exit, it's not just a technical issue, it's profoundly political.
How so?
If central banks stop buying government bonds, borrowing costs for Washington, for London, for Tokyo, they could skyrocket.
Which would expose the huge subsidy that QE provides to governments.
Exactly. The source warns of the Hotel California problem.
You can check out anytime you like.
But you can never leave. Central bankers face immense political pressure to continue the code red policies long after they should have ended.
So given this volatile, uncertain landscape, what can the learner actually do to protect their savings?
Well, the source emphasizes you need a plan beyond just hoping things magically return to normal.
And the first step is avoiding mistakes.
The first step is avoiding common mistakes that get much worse with volatility. This includes borrowing money to invest. Leverage is so dangerous in these markets, overpaying investment fees, trying to time the market, and home bias.
The tendency to just buy stocks from your own country.
Right, preferring familiar local stocks even if they're not the safest or most profitable globally.
So the recommendation is to diversify away from assets that are purely growth dependent, like a traditional 60-40 portfolio, and look at things that thrive when inflation is rising.
Yes. And the core investment strategy the source emphasizes is buying stocks in companies that have a durable economic moat.
A concept from Warren Buffett.
A concept popularized by Warren Buffett. A moat is a competitive advantage that sustainably allows a company to keep competitors at bay. And crucially, a moat gives a company pricing power.
The ability to raise prices.
The ability to charge higher prices to customers, which enables them to earn above-average returns, especially during inflationary periods.
That pricing power is the key to resilience when the value of the dollar is eroding. What are the main types of moats we should look for?
The source identifies 5 durable moats. First, intangible assets.
Like a brand name.
Brand value, like Coca-Cola, or patents held by pharmaceutical companies, or licenses held by S&P or Moody's. The power is in the non-physical property.
Okay, what's number 2?
Second is network effects. Here, the product's value increases with the number of users. Think of Facebook, eBay, the Apple iOS ecosystem. It becomes too inconvenient to leave the network once everyone you know is on it.
Then you have the efficiency plays.
Exactly. Third is the low-cost producer, which relies on efficiency at massive scale. Companies like Walmart or UPS, they can operate at margins that simply crush smaller competitors. Their scale is the barrier.
And the final 2 are related to making it hard to leave.
Fourth is high switching costs. This means it is difficult, costly, or disruptive for customers to leave. For instance, moving a whole company off an Oracle database costs millions and takes forever.
And the 5th.
Fifth is efficient scale. This applies to niche or, geographically monopolistic markets where new competition would be uneconomical, like local quarries or certain regional airports.
And this is a crucial distinction.
Yeah.
We need to remember that great products, great management, even massive market share, those are all considered false moats.
Because they can be duplicated or eroded quickly by a clever competitor. The Palm Pilot was a great product, but it was wiped out by the smartphone. A moat has to be durable.
So where does that leave us?
The era of financial repression will continue to morph into a currency war, creating tremendous market volatility. The core challenge for the public is realizing that these code red policies create debt bubbles, and those debt bubbles lead directly to financial instability.
So if central bankers have an unblemished record of failing to spot bubbles and forecasting recessions, if they're driving by looking in the rearview mirror, what makes us think they will know exactly when and how quickly to take their foot off the code red accelerator?
They won't.
Without triggering either a deflationary bust or an ugly inflationary deleveraging. This uncertainty is the defining characteristic of the next decade. And it means you have to assume volatility and build resilience into your savings now by prioritizing pricing power and those competitive moats.
That's the playbook.
That was a deep dive into the coming financial turbulence and the actionable investor playbook to protect your savings.